Okay, so recently, since the start of the year actually, we have been experiencing this soft patch in volatility which has impacted the industry to a certain extent. How much has it impacted it, and do you see any changes stemming from that ongoing issue? Who's going to start?
I'll kick off if you like.
Yeah,
I feel like we're at an interesting sector of the industry where we do have visibility through to a lot of different segments. The retail broker segment and also the asset management sector. I think on the retail broker side, the decline in volatility has had some impact. I think in some of the primary trading instruments such as FX, volatility has declined, volumes have declined. Our business fortunately has not necessarily seen too much of that flow through. We've actually had a very good start to the year. However, what we have noticed is that the volatility has affected volumes in certain instruments significantly more than others. So FX volumes are down that we've seen from our broker network, but some of the other asset classes, bullion, some of the equity indices, and certainly single stocks and futures, those market segments haven't seen the same downturn in volumes as FX. From the asset management side and the hedge fund side of our business, we have seen a surge back to long-short equities as well. That part of the market has really continued to flourish, and I think some of the rhetoric around the trade war has really helped drive some of those volumes. But I think fair to say that FX has declined somewhat over these first few months of the year.
So what can brokers really do about this? Do you have any perspective, Harpal?
What can brokers do to increase volumes? We don't prognosticate about where volumes are going to go in the future. I mean, our observation is just, if you look at it historically, FX volatility tends to be more correlated with interest rate differentials amongst various countries. And during this period of time, post the financial crisis, when interest rates moved to either zero or negative, you moved to historically low volatility levels. In Q4 of last year, actually through most of last year, as people assumed that the U.S. Federal Reserve would continue to raise rates as they did over the course of the year, we saw volumes continue to improve. It was only, in the middle of the first quarter that after our president complained to the Federal Reserve that the rates were going up too much and that they should lower them back down, and people's expectations of rate increases decreased or subsided for the remainder of the year, that again you started to see volatility go down. The only thing I can say is if the U.S. economy continues to perform at the rate that it currently is, rates will continue to go up in the U.S. And if there's a faster speed growth over there than there is in Europe and other parts of the world, and in particular in China, if the trade movement continues to move in the direction that it's going, you'll probably start to see more position taking and perspectives. And as you see that, you may see an increase again. That's it. The one thing I will say, just about low volatility and what brokers can do, if volumes are going to go down and people are going to make less money, there is no better source of clarity in terms of how people allocate their resources when they're running out of money. So you will see a lot more rational, economically rational decisions amongst brokers about how they run their operations, how they staff it, and in particular how they allocate resources to technology.
Mauro, do you see these trends happening?
I will bet that if we'll ask the audience, no one will know, most of the people won't know there is a low volatility in the market because it doesn't matter anymore. We are in a market that is multi-asset today. Today, just to give you an example, most of our trading volume, all the network of 80 brokers is on Ripple. It's not on FX. And I think that the question is for the affiliate or the marketers, how are they going to attract clients while there is low volatility? I think focusing on other assets that have more volatility. And for existing clients, one of the ways to active them more and make them trade is to just give them tools that can be profitable. For example, strategies that work on a low volatility market, such as Bollinger Band, or all kind of strategies that can help the end user exploit the low volatility of the market.
So, Avner, do you see any decline in deposits due to the lack of interest in the FX market?
I would say that the majority of the markets, or even the existing brokers here in Europe, CISEC, FCA even, are shifting more their traffics and interest towards other regions, where the game is a bit different over there. It's not as complicated or matured as the European markets are. The traders over there, I would say in Malaysia, Indonesia, Thailand, Vietnam, even China, Southeast Asia in general, Japan, and new markets like Latin America, these traders are less, for them it's more the entry point, and the big brokers are now entering, and you see basically a new type of traders that are coming into the system, and for them it's just a starting point. So I believe the markets, the volatility of the markets currently is affecting mostly European region, is not as effective, at least from our side. We see increased volume, more and more new depositors, new FTDs coming into the system. I wouldn't say that I see this affect too much the retail broker. For them, it's a starting point. It's a good starting point to come with the brokers, international brokers that only now started entering into the regions I mentioned.
Okay, so let's discuss the elephant in the room, which are ESMA's new regulations in Europe. And this obviously has had a dramatic effect on the richest market which brokers have been targeting in recent years. So how do you see this evolution affecting the industry for now? Harpal?
You know, so from our perspective, we've been in these markets for a long time. I think whenever changes like this happen and people reach sort of immediate, sort of dramatic or emotional conclusions, it's better to kind of step back and look at history a bit. You know, if we look towards a market that has already gone through this type of change in regulation, you can probably form some kind of pattern of what's going to take place. And a good example is Japan. So, you know, the Japanese market, you know, grew very, very rapidly in the early part of the last decade. And after these similar types of regulations were introduced, there was a dramatic fall off in the number of brokers. Everybody said it, you know, was gloom and doom, and et cetera, et cetera. But you eventually saw, after a 2 or 3 year blip, a significant resurgence in that market, where today Japan represents, you know, probably 50% of the global foreign exchange market. And the firms that are in there are quite significant, are quite sophisticated, and are probably representative of what these markets will look like in a few years. And namely, they are technology companies rather than brokers. Okay, it is Yahoo Japan, it is SoftBank, it is GMO Click. These are companies with significant software engineering and technology teams. They're less so marketing companies and much more so technology companies. They have very sophisticated risk management. They have very sophisticated models, and they are capital rich. They have very significant market caps. And just to put this in perspective, GMO Click, up until recently, I don't know the exact numbers, you know, was doing somewhere between $40 and $50 billion a day in FX trading. Okay, that's not a month, that's not something else, that's a day. Okay, and these are all people that didn't know what FX stood for 10 years ago. They didn't even know what the word was. So I think that'll happen here. And maybe there are names of companies that we don't even know of today that'll be quite large players in this market.
Okay, so Invest has some experience with Japan. What do you think, James?
I think it's a very, very salient message. And apart from agreeing with everything that Harpal has said just now, we see this lesson playing out again in Japan just this very year. So aside from the use case where the regulators previously came in and increased the margin requirements, decreased leverage in Japan, the regulator, the JFSA in Japan, just this year was actually in discussion with the broker community around further possible changes to licensing and the regulatory regime. One of the things that was being discussed just this year was a further increase in leverage. Now, that hasn't actually played out within Japan or within the JFSA environment, but it was interesting to watch the reaction from the brokers in Japan as those conversations were unfolding. So we are fortunate that we have not only a Japanese listed parent company, but we have a number of institutional clients in Japan, those being retail brokers themselves. And their response to this round of questioning and this round of discussions with the regulator was to look at multi-asset diversification. Japan is a market which is very much focused on FX. There is obviously a large and, I think until recently, growing crypto market in Japan, but the market for products like bullion, index and commodity CFDs, single stocks, futures, exchange-traded options, the broader multi-asset universe really hasn't been the focus in terms of the delivery to retail. I think that is starting to shift now in Japan. We see a number of Japanese brokers applying for different license types, which will allow them to offer a broader suite of products, and the licensing is required in Japan for different products. And I think that we can draw, as Harpal says, we can draw some conclusions from that for the local market. We genuinely feel that a diversified product suite is going to be essential. And not just a diversified product suite, but a diversified product suite that works well in a low leverage environment. If you think about products that customers have an expectation of leverage, an expectation of gearing, but it's a much more moderate expectation, you're likely to find more alignment between the customer expectation and the regulator's desire in certain asset classes, those being single stocks, those being futures, those being options, even fixed income trading. So we firmly believe that part of the growth plan and the expansion plan is not just a diversification of revenues, it's a diversification of product that's going to drive those diversification of revenues. And we, as a business, are very much focusing on delivering streamlined solutions to both brokers and, to a lesser extent, to hedge funds in this capacity, a multi-asset offering.
Okay, so multi-asset is one way to diversify. Avner, you mentioned that you see deposits shifting away from Europe, so can you...
Yeah, it's very. I think brokers today are in a kind of a catch-22 kind of situation. From one end, the ESMA or post-ESMA regulation with the lower margins reduce the ability of brokers to generate profit from the traders, or basically cut off more than 50% of their revenue streamlines from these specific markets. So from one hand, you see brokers that are trying to do the same thing, but in different regions. You have Australia, the ASIC regulator, I would say in the past year, 12 months, it was a very good option for almost any broker, sophisticated and prestigious broker, to go and open an ASIC license. Having said that, you see in the last couple of weeks, now the ASIC license started also reviewing, asking questions, and maybe you would see it's the first stage towards becoming or matching the same requirements as they have in ESMA. For new brokers today, there is not a lot of place, not a lot of room, regulation-wise, to support higher leverages, and therefore their margins are staying very, very low. So where can they increase their margins? So it's either from different products, meaning to offer diversified products with increased margins, or to cut the cost, whether it's marketing, whether it's platform technology, manpower, efficiency, it doesn't matter. In the end of the day, it will lead into consolidation of the market, and only the big guys, as you mentioned, like GMO Click, which is a giant internet company in Japan, regardless to the FX business. They are gigantic listed companies. They have maybe 60 different listed companies under the GMO umbrella or UBO. So I think this type of companies, the big guys, would stay and would be able to make money in the end of the day. Until then, it's very problematic for all the medium-sized brokers how to get there and how to maintain or survive.
Okay, so Maor technology is once again leading the way.
I don't think technology is leading the way, by the way.
Okay, great.
If we look on the companies that were mentioned, Yahoo, GMO, Internet, all of them are big internet companies. They are marketing companies. If we look on the biggest broker in the world that is only operating in Japan, it's called dmm.com. Anyone that don't know him can check. It's a soft porn and other stuff website. The FX is just a tab in the website and is the biggest by volume. So technology is highly important, but it's not leading. There is a full funnel that the marketing and the sales and of course the technology is supporting. I just want to say one point. 10 years ago, when I registered to a broker, after I registered, I saw dollar bills flying around, and it was okay because there was no regulation. Now it's not okay, but I think there is a big opportunity for brokers that will choose not to run away from the regulation. We're actually seeing a lot of big unregulated brokers today are fully regulated, and when everybody are running away from Europe, and it's definitely one option, the groups that are staying and are putting efforts in user experience and proper acquisitions and using AI to predict who's my VIP clients, I believe this is the best opportunity that was here for a while. For example, Equity Capital, they're doing a great job on user experience and acquisition. And I believe that the ones that will overcome the challenge will take all the fruits. And I strongly recommend to have a unit that go to Asia and other places, but definitely a unit that tried to upgrade, to bring a new standard from marketing, sales, and customer service. And I think there are few companies that are doing it, and they are the ones that will conquer the European market.
You know, I completely agree with what you're saying. And maybe it's just a clarification of point. What you just described in my words, what your words you just said, I call technology. So when I say technology, I'm talking about being able to scale an operation. It doesn't mean you ignore marketing. It doesn't mean you ignore all these other kinds of things, but you have to do it at scale. You have to do it at automation. You have to do it at a level that you can survive with lower margins. So even in DMM's case, they are a successful porn company because of technology. I mean, they're really good at
100%, you are totally right. But in marketing today, the fact that you're seeing an article on the gold going to go up, and after 10 minutes you're seeing a banner from FX Pro or DMM you to trade on gold, after they brained you, they gave you the message without you knowing, it's technology. I'm just saying, software, we can't call everything software. We need to separate. But yes, I totally agree with you. Marketing, it's definitely technology.
So one of the key issues why we ended up here with increasing regulation is the profitability of retail clients, and something brokers have been not very worried about in the past, but they're suddenly now paying more attention. Do you think that they can do anything to boost the profitability of their clients, and is perhaps asset management a way to diversify and offer a more upgraded product to retail clients?
I think yes. I think, speaking specifically on the broker side again, if you look at the profitability ratios amongst the retail consumer trading public globally, I think it's safe to say that the lower leverage environments, the lower leverage products, do generally have higher profitability ratios amongst that trader cohort. Again, I don't want to harp on the message, but diversification I think is going to be critically important of product, because as you diversify product, especially those lower leverage products, single stock equities, futures, options, and create a diversified trading environment for your clients that encourages them to diversify their trading, I think that's going to have one positive impact. I think specifically on the asset management side, we are in a bit of a unique position that we serve quite a few asset managers, hedge funds throughout Asia in particular, but a few here in Europe as well. And we certainly see an increasing overlap in terms of technology that's used by the broker cohort and also the hedge fund and alternative investment management cohort, and also the product set that is being used by those two brokers. So as those two worlds converge more from a technology perspective and a product perspective, I think you're going to see positive benefits for the end trader and those profitability ratios. In terms of brokers themselves launching asset management units or an internal fund or an alternative investment fund, we do think that there's a reasonable opportunity for that. It's been very interesting to spend the week here in Cyprus. Myself and the team have come over from Sydney, Australia, and hear what plans the local brokers have here for different components of their business, including launching either funds or alternative investment funds here. Clearly, listening to the regulator's speech before from SciSec, it is a sector of the industry that they're very much looking to promote. And I think that, it's our view as a company, and it's a strategy of ours actually, that this regulatory environment is probably here for a minimum of 5 to 10 years. That's our view. Could be wrong, we're not experts, but we're aligning our businesses and our strategy with that sort of outcome. As an ASIC-listed broker ourselves, we're very familiar with what's been taking place down in Australia recently, and I completely agree. I do think that Australia and other jurisdictions thereafter will probably move to fall in line in some regard and to some extent with the ESMA regulations. We know that our regulator in Australia is sending a delegation to China in just a few weeks' time, and that there is a very active dialogue between most of the larger regulatory bodies globally. So I think to sort of ignore the fact that the global regulators are speaking more openly would be to the detriment of any business. And I think aligning your products and aligning your offering to that lower leverage, more diversified, more tightly scrutinised regulatory environment is only going to be a positive thing. And I think for the brokers who are planning to take that step and take that evolution, I think even the diversification of product within an asset management division is going to be very, very helpful, because to have an asset management division within a brokerage firm that's only trading FX, challenging.
Great.
I think it's important to separate out two distinct value propositions that operate in this space. One is trading on highly volatile, leveraged, moving assets. And to be fair, I just view that as entertainment. I mean, that's gaming, okay? And if you can trade where something moves and you can see your bet go up or down fast, that has entertainment value. And there's nothing wrong with that. I mean, lots of trading that goes on around the world, regardless of asset class, has that feature and experience. Regulators have the job to protect the end user against, over abuse in that area. And every single one of these products follows the same maturity arc of something new gets introduced, it gets exploited, regulators come in and they tamp down on it, and then it moves into like a steady state, lower leverage form. That has happened over and over and over again. It happened in the futures market, it happened in, we've seen all this. The end state of that is where we are in Japan, where it's still gaming, but it's controlled and people are relatively protected, and it ends up being dominated by a few very large-scale organizations that can succeed there. And I think it's totally fine to keep introducing more and more products, new asset classes, whatever we want to call them, that then go through that same maturity cycle. And it's very profitable in the beginning, so find as many of those as you can and keep rolling them in. I think so that's a model, and that's good, and I think you just keep doing it, and you just recognize whether you're in the early phase, the middle phase, or the mature phase of the cycle of any one of those products. This other aspect of assets under management, of asset management, generally speaking, is just a totally orthogonal value proposition. A person that's going to invest their money and just sit there and watch, or put it in a fund and not actively trade it, doesn't get the same entertainment value as the first one. He's an investor. And we can call the first category investors, but I think that's disingenuous. This second category of investment, where FX is an asset class, or we can innovate in ways where people want to back a particular trader or a model or a fund manager or portfolio manager or whatever, that's a really interesting case. And I think there can be really good innovation there. And I think if brokers come out with good products, a institutionalized version of copy trading, where you can follow someone else's success in the asset management space, I think it's a fantastic innovation. We just have to recognize that it's not in the first category, and it's a different customer set, and it's a different value proposition, and we should go for it. I think you achieve diversification of your revenue streams because it's a different customer category, but it's not just another one of these things that are going to go through its maturity path. So I think it's a fine thing, but just let's not get them confused.
Okay. Maur?
So brokers want to be more profitable than what they are today?
Well, that's for you to answer.
Always. So I think if we go to the basics, if you want to have a more profitable business, you need to do three things actually. You need to have happy customers, so give them a customer service like they are in a Michelin restaurant. 2, you need to keep them engaged. Most of the trading platform today You come, you see a chart, you don't know what to do. You need to keep them engaged. You need to make the trading into a daily habit, okay? So you need to keep them engaged. And the last thing, you need to reduce your cost. A lot of brokers today rely heavily on technology. They're not specialized in technology, and I highly recommend them to reduce the cost by partnering with the technology. That was a marketing message, forgive me about that. But I will say that most of the brokers today don't separate between the two segments that Arpal mentioned. First, they are the traders. You need to give them a specific treatment. And the big challenge is that a lot of traders don't want to trade, they want to invest. And the question is, how do you engage with investors that even that their portfolio right now is not in an amazing situation, how do you encourage them to participate more in the market? But broker that will make their client happy, will give them a proper service, will engage and will reduce cost, will be more profitable, and still the brokers they don't have anything to complain. It's a profitable business.
Yeah, so I think like first of all, the way for broker to make money, assuming it's STP broker, is by how many lots or how many positions the end user is opening. It's as simple as that, at least from the retail point of view. So from broker point of view, you need to do everything you can in order to educate the end user and for him to be able to open as many positions as possible. Obviously, STP broker would like the end user to gain money, otherwise he will lose and not continue to trade. Having said that, so I believe that the main focus should be on education, how to make the broker, how to make the end users understanding what they're doing, which is not the same classification as you mentioned with the asset management portfolio. Personally, I don't believe in this type of investments, because to everyone or each one of us is different, and we have different flavors and different risk exposure that we are willing to take, and in different phase in our lives, and it's very different from time to time. Personally, if you take some amount of money and to give it to someone else, I think that's where the problems might start. What happens if you don't like the strategy or something changes and the strategy continues? And in the end of the day, I think the 90% of the retail brokers, counting on exactly what you said, this, I call it this bug. The moment a person opens a deposit, he sees the graphs going up or down, and this specific thrill, and then he can tell his friends about how many shares he has in this, or how much money he had, or lost, or whatever, and it gives him the additional edge that he needed in order for, he could have gone to the bank and maybe make a trade through there. So that's exactly the difference why an end user will come for online broker and make and put a great amount of monies. Anyways, you need to filter after you've given them the education, who are the best end users, who are the most professional customers that you have, and for them to build a VIP, a kind of type of engagement like Maor said, and basically to take them and filter or refine the best end users, or the one who doesn't want this specific gamification type of thrill.
I just want to add that I believe the problem in the market is not low volatility. The problem in the market that most of the participants are looking to increase profitability. That's the problem. Most of the companies don't have a long-term strategy. And what I'm trying to say is that now it's the time to increase the market share, reduce profitability in order to have a long-term strategy, because right now a lot of companies in the industry are, and that's the reason why regulators come into the picture, because a lot of brokers are looking for short-term profitability. And I think that companies that want to be in the market for a while, they need to focus on stability and for increasing market share.
Okay, so speaking of volatility and excitement from trading. Cryptocurrencies seem to be back in the picture in the past couple of weeks. Do you see increasing interest on part of the industry going back to crypto after a dead year, so to say?
It's not a product that we actually intersect with, so I'll hand over to my fellow panelists on this one because it's not an area that we actually engage with that actively.
Harpo?
So with the final episode of Game of Thrones, the crypto winter came.
Please, I haven't seen it yet. We can't speak yet.
The crypto winter came and it has ended. Well, I don't know if it's ended, but we can only speak from our perspective. So we extended through our relationship of brokers around the world who were trading crypto assets with their customers, whether they be CFD or physicals, and launched an exchange earlier this year, late last year. I think the exchange, albeit relatively small compared to fiat, surpassed 50 million in ADV last week, which, if we look at what are sort of correctly reporting exchanges, puts this new exchange, we call it Mint, in almost a top 10 or top 12 exchange in the world after 4.5 months. So we look at it and we say, it's probably a much lower market than it was a year and a half ago, but starting from zero, it's going to grow quite large for us. I think the real important issue about crypto is how it is going to effectively get regulated. And in Japan in particular, again, I'm going back to Japan because I just think they're further ahead of everyone else. It is a completely regulated market now in Japan. It has very clear rules, it has very clear mandates, it has very clear leverage ratios, it has very clear compliance and custody and segregation of funds and so on. And as of a month ago, they're allowed to start advertising again. And I believe in the next few weeks, as Facebook releases their own version of a cryptocurrency, they're going to allow advertising again for cryptocurrencies there also. So I think you're actually just going to go through another phase. And it was just like what we talked about. These things start off really high, they come down, they really consolidate, and it has a slower growth curve that'll start moving up. But it'll be a 5 to 7 year cycle before it follows the other assets.
Right. Maur?
Wow.
You mentioned Ripple.
You won't believe what's going on the crypto space. My neighbor, his name is Greg, and he's the owner of Cointelegraph, Charlie, EatBTC, and a few other companies. He's a billionaire, but he looks like a homeless guy. Don't tell him I told you that. But he's telling me about the insiders and what's going on in the market, and a few things. If you have time and money, go into crypto. It's the best bet you can do. That's at least my recommendation. If you don't have time and money, that's a different story. Now, for the short term, if we look on the FX side, there are a lot of crypto regulators in Belarus, in Estonia, that allow you to operate as a crypto exchange and other different structures. So if you have an online business that's doing trading, I would recommend at least to explore different structures that accept crypto under some regulation. One of the biggest issues in the industry that Zota is leading the way in solving is getting payments from the clients. And crypto, Bitcoin is actually solving it, and you don't have chargeback, you don't have rolling reserve that you'll never see. And by the way, today the brokers that are closing, it's not because they don't have happy customers, it's because they're chasing the money from the PSPs. And if you work with Zota, you have good PSPs, but I'm just saying. Now, for the long term, and I will stop here, crypto and regulation don't go together. It's not it can't be in the same world. Crypto, if you understand the concept, and I don't understand, but if you understand the concept, it's a fully decentralized, unregulated, uncensored, and I believe the volume will go there in the future. So short term, enjoy the regulation that is a light regulation and you can do a lot of stuff. On the long term, regulation won't be able to touch crypto.
Avner.
Very interesting. Yeah, Bitcoin crypto is here and it's here to stay, that's for sure. For us, it's now round 3, I would call it. If the first round would be all the Chinese crazy that took it from 200 to 800, 1,000, and then from around 3, 4 to 19,000, this is the third round from an industry scale level. And if you take it from like 5, 6 years, it's exactly like Fibonacci said, how a graph should go when you go up. Go up and then go down a little bit and then go up more and then go down a little bit and then go up more. In general, the crypto and Bitcoin are here to stay. I agree that it's non-regulated product by its essence. It's come to replace all the regulators, all the banks, all the necessity of a regulator. So basically 2 individuals or 2 companies can contract with each other or settle with each other upon a certain market price that it is agreed between us, which is not related to any US dollar, treasury, euro, banks, SWIFT, wire transfer, or so on. This is A. From our personal experience, we have also in Tel Aviv, we have ATM shop, which is a physical exchange store with only bills, notes, in order to reduce, obviously, the challenges where you have with online transfers, transactions, and Bitcoin. We see they are totally opposite, and we see that the mass people, when the market is down, the store is relatively empty. When the market is very high, a lot of people come and buy Bitcoin, which should be exactly the opposite. When the market is down, buy the Bitcoin. When the market is going up, sell this Bitcoin. We still see it's different. And the market, I would say, I feel it's the early days like of the internet. Before the Google era, nobody knew how to use the internet. You had the different pages with images, and you clicked, and modem is more or less the same. Japan is a great example how to regulate and how to enter it into day-to-day life. You have first-tier assets, second-tier, which Bitcoin, Ethereum, and other cryptocurrencies is what is right and what is prohibited, and so on.
So I have one more question for you, but before that, let's hear from the audience. You have any questions?
Hello, my name is Marcin Nowogórski. I'm from Comparec Media. So what I hear from you, from this panel, it's like we will be in Europe, we will have situations similar to Japan. So consolidation is inevitable. The margins are going lower. So if I would be a broker, I would be operating in Europe, I would be depressed with such vision. So can you send some optimistic message to all the brokers? For example, if a broker would do a marketing right, a technology side right, educate more on how to do things more efficiently, could he be calm for the future that he will stay in the business?
It's easy. You need to take Zota as a payment provider, you need to take us as a technology provider, you need to take Integral as a bridge, and liquidity with Invest, and you will be perfect.
So I would say just follow what other firms did in a situation. So simple answer is upgrade your technology, upgrade your tech. Now it depends how you define that, but I'll give you one very small example, right? So when DMM and GMO really went and expanded the market after the deleveraging, one of the ways they did it was by significantly reducing the spreads in the Japanese market. So where the Japanese market used to be roughly 2 pips wide, presented by all the brokers up until about 2008, 2009, something around that range, they came out with advertised defined spreads of 0.3 pips for dollar yen. And they said it would just always be 0.3. Okay? They put it out there, and their volumes went through the roof. Lots of people came into the market because the cost of trading went way down. And at first, they lost a lot of money. And there was one very important thing they had to solve. They had to know where the market was, where the midpoint of the market absolutely was at any point in time if they were going to give such a tight spread. So my main point about one of the things they did in their technology is this. When you're giving a 2-pip wide spread to the market and you're internalizing much of the flow, you have a huge amount of room for error, margin for error. You can make lots of mistakes because there's so much profit in there. And yes, the broker's profits are quite high now. If the profits are going to go down, your business has to become extremely precise. It has to scale, it cannot make mistakes, and it cannot lose money. So one of the key things you're going to need is absolutely spot-on market data. So I will tell you, this past week, we announced that we are now delivering institutional market data to the retail segment. Where did this come from? This came from the work we've been doing with the Japanese for the last decade. So this was part of the stack that fundamentally changed how they were able to offer 10, 20, $30 billion a day of trading with incredibly tight spreads and still make money. They had to know where the market was better than where their customers thought the market was, or knew where the market was. And if they could do that, they could eventually move to, there's just one of the aspects that had to go into getting to scale. European brokers will do this, because by definition, the ones that don't won't exist. The ones that do will become the big names. So it's an easy prediction to make, because we've already seen it.
Okay,
I don't have time for a joke, right?
No, that's exactly the reason why we did a whiskey bar. So you can come and drink, it might help. Exactly. No, I would like to say something optimistic. Anyways, in any business, if your business is based on good people, human resources, and you do it efficiently, and you run a good business, it will be good, no matter what, no matter which industry, no matter where in the world. So just believe in ourselves and what you do, and it will come.
Well, thank you very much for the great discussion, and looking forward to seeing you again.
Thank you, Victor.
Thank you.